Welcome to our first Mastery Series preparation webinar. It's Wednesday, March 15th, 2017. Thank you everyone for coming out. It's great to see you. So couple of quick notes before we turn it over to Jim. If you're here and you know you're versed in Jim's work, you may not need to be here. It's great if you want to hang out and watch, but this is going to be very basic. And if you're brand new to Jim's work, this is going to be a fabulous start for you. It's really our objective to get everyone up to a working knowledge that will enable you to absorb as much as possible from Jim's mentoring in the first course 1. And obviously there are several and many going on to course 2, but we want on May 1st you to be ready to hit the ground running and just get as much as you can out of the investment you made in this service we're providing here with the Market Profile Mastery Series. The second thing I want to go over very briefly, if you're looking at my screen right now, let me put it to the training site. Right now, this is a secured site, and once we begin the Mastery Series, all of you, it'll be secured content through and through. You will not need to register for webinars. You'll be auto-registered every day because we have so many webinars, and our friends in Texas are just a godsend. They take care of the auto-registration to make your lives easier, so thank you to you all over there in Texas. We love you. But for right now, because we have a mix of Mastery Series traders who are enrolled, we have JD members here who are not enrolled, and we have a few invitees and people that are neither, just coming out to check it out. And we thank you for being here too and taking the time with us. So we have not secured these two top nav items. So where are the reports, Julia? Well, we're sending the reports in an email. We've had some deliverability issues, and we are very sorry for the inconvenience. If it has affected you, we are working on it. And please stay in touch with us if you are not getting emails from us. But for now, you can always come to the training.jdaltontrading.com, and you can go under Kickstart Reports, and you can download the PDFs here. I haven't made posts of them. Right now, just use these PDFs. Keep them in your folder for this program. We suggest that you make a folder on your hard drive so that you can take this program with you. We do not secure content for you. You get it all for your personal archive so that you can go back and review and use it as much as you can to be the trader you want to be. So every time we do a report, which is twice weekly, Sundays and Tuesday evenings, we're going to post them right here for you. So you can always come to Kickstart Reports. Whether you're in the Mastery Series or not, this is not a secured page. The second thing I want to point out is the webinars. Upcoming webinars are also here. And if I drag the slides to the handout section, but you can also grab the slides here. And you can register for all the webinars at this page. I did not put the password here because we're trying to secure this content somewhat so we don't have a mass of people in here. We want you to have the individualized attention that you're entitled to and that we want to give you. So if you need a password, those are going to come to you in email form. But you can always email us. There were people this morning. I haven't been communicating as clearly yet. We're still putting this together. But just email me. I'll make sure you get the password to get in. The last thing I want to say, boy, I'm chatty Cathy today. I'm going to go over right here. We're at the member site. This is our public site. And we've added this top nav drop-down video clips. Okay, and I know you received an email about this, but this is just a new navigation link. And this is where we're going to introduce, well, we have introduced, but we're going to continue to use this teaching tool, which is relatively short videos that enable you to see things happening in real time. This first one was silent, and Jim didn't want to talk because he said, no, I don't want to talk. I want them to have to think and focus and see it for themselves. So this is something we're going to continue to do as we shift our model of educating after the Mastery Series is completed, and go to more of this video clip. So for example, on this video we released Sunday night late, there's a 45 line. So what's a 45 line? Well, you can read it in the glossary, you can find it on the, in the trading articles and our premium content, but you can also watch it here. This is under 10 minutes, about a 9-minute video, and you'll have a much better sense of the 45 line. So I just wanted you all to be aware of that new resource that we're making available to you. And I think I've talked enough. But if you have any logistical questions about accessing content, passwords, password resets, anything that we can help you with, please reach out to us. Jim and I are so appreciative of all of you who, enable us to share Jim's work with you. We couldn't do it without you, and we love you. We want you to get everything you can. We're just thrilled you're here. So whatever you need, we're here to help you. So please let me know anything you have for questions or anything with the logistical side. And of course, content-wise too, both Jim and I look at our emails and we pretty much tag team who takes what. So I think I have talked your ear off now, so I think I'm ready to turn it over to the master. So thanks for listening, thanks for being here, and I'll turn it over to Jim. Hi, Jim.
Thank you very much. Is my screen showing?
No, let me get that over to you right now. Okay.
We should be live. Okay, first thing I'm going to say, you've heard me say before, but I want to come back to it. We're starting extremely basic. We have 7 of these. They will increase in intensity as we go. And what we really hope is that when we get to the 7th, when we complete the 7th one, you have enough background in order to get the most out of Mastery Series 1 and 2, if you're only taking one, or both if you're taking both. Remember that unlike if you go out to play tennis, you can gradually learn to play tennis by challenging or playing competitors that are on the same level with you. You do not have that opportunity when you become a trader. When you become a trader, from the very first trade that you ever placed live, you are competing against every other trader in the world. There is a tremendously high failure rate among short-term traders and early traders. And the reason is they really haven't been prepared for it, and it's hard to fathom the fact that you are exposing your order to the best traders that have been around forever. The worst ones have fallen by the wayside. So it is extremely competitive. However, if you really start to grasp what we're talking about, you will have a fighting chance, because we're showing things that very few traders, including a lot of professional traders, really aren't aware of, and particularly when it comes to very short-term trading. So we are basically focused on day time frame and 2 to 3 day trading. We are not really intermediate term traders. We're not longer term traders. We always look at the longer term, we look at the intermediate term, and we come down to get a perspective. But the majority of our client base and what we focus on is relatively short term in nature. So you can compete with this information, and let's get started. The first thing is just that the foundation, the market is simply a two-way auction process. The motives and incentives in the buyers and sellers are virtually infinite. I always get the question, well, who would be buying, who would be selling? It is impossible to really tell you, because some people may be covering shorts, some people may be hedging, some people may be going on a wild speculative bet. There's so many reasons, and you don't want to think about that. We want to think more broadly in the overall competition, and we're going to talk a lot about competition as we go. One of the first goals you have is to be able to see the market as a two-way auction process. Throughout the day, you may see a market that opens in the morning and, oh, it's pretty clear, it's trading higher. Well, that's auction one. And then you'll see a counter auction where the market starts to trade off. Each of those auctions contains important information. But you want to get to the process of understanding, and when you look at the market, to be able to think, there's an auction up, there's an auction down. Some of them may be very short, but each one of those auctions contains some information. And but think of an auction, most of us think of an auction process where it only goes in one direction. You go to an hard auction and the auctioneer, but here's the first important concept. The auctioneer may try and get the auction started at, let's say, $100,000. He said, who will bid $100,000 or blah, 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 blah. If no one lifts the bid at $100,000, what does the auctioneer do? Before long, he's at 98, 99, 97, maybe 95,000. All of a sudden, at 95,000, you have 95, I got 95 and a half, I got 96, 96, 97 and a half, 98, 99, I got 99, I've got 100, 101, and you'll see the auction. Nobody will lift the bid initially at 100,000. It goes down to 95,000, for example, and all of a sudden the auction gets underway, and that auction may now come very quickly back up through the $100,000 level where no one would lift the bid just a few minutes ago. That happens all the time, and we see that constantly in the markets, constantly. And that is just, it's something you need to understand, and it's that idea of getting started. Now, once the auction is underway, we're always talking about tempo and volume and things, but think of it in another way. If you ever have been to an auction, when the auction is moving very quickly or very rapidly through time, all you hear the auctioneer is saying, I've got 98, I got 98 and a half, 97, who will give blah, blah. Now, all of a sudden, as the auction starts to slow down, you will hear the auctioneer start to add filler. Who will give 103,000 for it? And he goes on, trying to make it sound exciting. When that filler comes in, when the auctioneer is doing more than just talking about prices in the bids and the offers, that's a sign that the auction is slowing. It doesn't mean that it's over, but it is a sign that it's slowing. Another thing that happens in an auction, and this you need to be reflecting on yourself. A lot of times you may think that something is, say this art object is worth $100,000. Well, if that's all you're willing to pay, that's your opinion. But that may not be what the other participants in the auction see at that moment in time. For example, let's say the market starts out at, nobody will lift the bid at 100,000. It gets underway at 95,000, and finally at 102,000. Instead of the auctioneer adding filler, you hear the auctioneer say, new bidder. And you hear the auctioneer new bidder, that means that higher prices are bringing in more activity. We see that in the market all the time also. All of a sudden, you get kind of complacent, and all of a sudden you get higher prices, and the market just explodes. This happens often around significant references. You break out of balance. So you got a 10-day balance. Maybe the volume is relatively low, coming up to the high of the 10-day balance. All of a sudden, price works its way to the other side of the 10-day balance, and price explodes to the upside. That happens all the time. Other times it will come to the 10-day balance, it'll maybe look above it and it won't explode. And all of a sudden it starts to auction back in the opposite direction. These are the kind of thoughts that you need to have as you're watching the auction. Too many people have a very difficult time trading because they get fixated just on price. That is a killer. If you are overly influenced by price, you will have a very difficult time being successful. There are so many emotions that we have, that we fight as we're in the market, our own personal opinions, what we've heard from somebody, some news report we've seen, and the other thing, and price movement stimulates a lot of impulses. If you're going to be a successful trader, you are continually fighting a lot of perennial impulses that we have. Very common. So this idea of understanding what's going on, understanding the two-way auction process, so you get to the point where you really do have a feel for what it is, and you understand that price is nothing more than an advertising mechanism that is used in the auction process. Okay, so that's the first thing, is that the foundation of the market is simply a two-way auction process. The motives and incentives of the buyers sellers are virtually infinite. Don't waste a lot of time saying, well, who would do that, who wouldn't do that? That makes no sense. That is a very bad path to go down. Okay. What the market profile does, it simply records the market's two-way auction process that allows us to view the market's structure. Let me give you a little history of how the profile came along. The profile was developed by an individual who was a statistical major, stat major at Stanford. He was also a floor trader on the floor of the Board of Trade. Historically, on the Board of Trade, short-term traders operated via sound. If the market, for example, went up to yesterday's high, there might be a lot of traders in the crowd bidding the market up in order to try and hit or trigger the stops at yesterday's high. As you got to yesterday's high, if it goes through that high and the volume increased, the traders on the floor immediately continued to bid more aggressively because they knew that higher prices were bringing in more activity. If it got up to yesterday's high, for example, and the volume dried up, the traders immediately began offering because they knew that higher prices were cutting off activity. If you are auctioning higher, the expected result is for higher prices to cut off activity or dampen enthusiasm. That's the expected price. You go higher, and you would, if you see the price of a car go up, you would expect that to start to restrict sales. In some cases, however, higher prices have just the opposite effect. And when that happens, that is a sign that something has changed. People's attitude has changed in the market, and we see this happen continually. Now, just to have a picture, and you're not looking at me, so it's kind of hard to see, but take your hands, put your hands in front of your face with the palms facing you. The traders on the floor, when their palms were facing them, hands out, palms facing them, that meant they were bidding. When they reverse those hands, reverse your hands, palms out, that meant they were offering on the floor. So another picture, if we go up to yesterday's high, and the level of volume on the floor which tells you the outside flow of orders is increasing, the palms stay in, and those traders are bidding aggressively. We go up to yesterday's high, and the volume, the outside flow of orders slowed down, and the noise was very low. Those hands automatically turned to palms out, which meant they were offering. So that was how a lot of the floor traders and short-term traders made a living many years ago. As you know, as floors have gone electronic, what the profile does, it takes that short-term information away from the ears and it places it on the eyes. So the development of the market profile allows us to see and interpret what is going on among the flow of orders from the continuous two-way auction process coming into the marketplace. The profile does not tell you to buy. The profile does not tell you to sell. We are not profile traders. We simply employ the market profile in order to organize the data that is continually flowing as a result of the market's continuous two-way auction process. What we're going to be doing as we go through the educational series, we're going to be working on interpreting the data that we see from this organization. Okay, so right now you're looking at, on the left side, you're looking at a collapsed profile that happens to be yesterday's. On the right side, you are looking at an expanded profile. So yesterday morning, you see that the first 3 hours, the first 3 half hours, the market basically traded lower. So that was an auction. Then we had a short-term auction up. We had another auction down. We had an auction up. We had a small auction down. And then we auctioned higher going into the close. So you had and even within these, there were these are 30-minute bars. Each one of these is 30 minutes. So even within these, there were several additional auctions. But here just reflects, an hour and a half down, about an hour and a half up, about an hour down, hour and a half up, a little down, and the final, couple hours to the upside. Again, that's what the continuous two-way auction process looks like when organized under the market profile using 30-minute bars. And we'll get more to that in a second. Okay. The theory behind the profile is a normal distribution curve. You're just simply trying to organize the data. Scientists for years have used distribution curves in order to organize the data. Once the data is organized, they have a better opportunity to observe and make sense of that data. Let me give you a very simple example. Let's say that I have a barbecue in my backyard and there's 70 people there. You come up and you ask me, what do I think the average height of the people at my barbecue is? I have no idea. I kind of look at you strange. But however, then I walk out and I say, wait a minute, and I organize those people. I put the tallest people in the center, and then I put the shorter ones going out to the left and the right. What I've done, I've just organized that data. I've got a distribution curve. Now I may look and I say, well, I think the average or median height is probably someplace around 5'10". So two of us could have been looking at the same data, one unorganized, and they go, I have no idea. The others, it's organized, and you say, I have a pretty good idea what the average or mean height is. So again, there's value in organizing the data. Our view is that you can gain an edge by being organized and having the data itself organized. Normal distribution curves, and the market's really not normal, but we start with that. In order to form a distribution curve, the scientists have to have a constant and a variable. So what has happened here is, say the time is the constant. A half an hour between 6:30 and 7 is the same as a half an hour between 7 and 7:30. So time is a constant. Monday's as long as Tuesday. Tuesday's as long as Wednesday. So time is a constant. Price is the variable. If you compare price, a variable, to time, a constant, you will get a distribution curve. So that's all we're doing. It's just simply a scientific way in order to organize the data that we will be looking at in order to make trading decisions. All we've done here, we've taken a profile from a couple days ago. We've shown the profile on the left, and we've shown the distribution curve on the right. Now this was a, whoops, I don't know what happened there. It was an inside normal day. They don't happen that often, but Julia picked this and said it's a great example to show you what a normal day was. And the day on the left was a normal balancing inside day with very limited opportunities. So as you go through this, as you become more familiar with the profile and recording the data, the puzzle is starting to fit together and you're starting to get some idea of the way markets work. Each of the separate letters is a TPO, or a time price opportunity. You won't hear that term very often going forward, but it's just simply, there was one TPO at a single tick above yesterday's high. There were, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 TPOs at, and we'll talk later, at the widest point on the profile. Again, it's a way to organize the data and get some idea where the market was spending the most time. So the horizontal line is a constant, is time. The vertical line is price, the variable. Here's another way to look at it, and this just shows you how a day develops. So the first period is 30 minutes. And let me stop at this point and say, when people first get introduced to this, everybody starts, well, maybe I'll use 5 minutes, maybe I'll use 15 minutes, maybe I'll use 30 minutes. I have found that 30 minutes is the best time frame, and I've been doing this for many, many years. I've experimented with every time frame out there, and I have found that 30 minutes gives me the best perspective of what is going on in the marketplace. So the example here, you're looking at what the market looks like between 10 and 10:30. You see what it looks like after an hour, what it looks like after an hour and a half, 2 hours, 3 hours, going through the close. So you just get an idea that, all you're doing is recording on the left-hand side the range for the first 30 minutes. B period, you're recording the range for that period. Sometimes you'll get an extension to the downside. So, you'll record the market. It'll overlap where there's been before, and it will be single prints when it's new. This just shows you how a profile develops throughout the day as time goes on. Okay, the first hour of trade, as you see right here, it gives us some idea. Now, for those that have read either Mind Over Markets or Markets in Profile, there have been several things that have changed since I started doing this many, many years ago. The theory hasn't changed. The theory This is what makes it powerful. The theories haven't changed. My way of teaching it and the labels have changed. For example, we used to call the first hour of trade the initial balance, and then what we would measure any change relative to the initial balance. I don't use 30 minutes or 60 minutes exactly. I take a look and see where the market appears to settle. So it may be in the first half hour, it may be in the first 2 hours. But I'll look to see if the market forms kind of a natural base. But when I start looking at the left-hand side, recording the highs and lows for the day, we start to get some idea of what the profile might look like as we go through the days. On a rotational day, the ranges are relatively small. And you know, this idea of looking where balance is occurring is more important because the opportunities are small and the market rotates from the highs to the lows. So looking at that first hour trade or getting some idea where the market sets up its early balance, pretty interesting on a rotational day because it gives us some idea that, you know, where do we trade against those rotations? Where do we buy? Where do we sell? You know, not exact, but I mean, are we basically fading the market, meaning going against rallies and buying on breaks, which is more common on a rotational day. On a trend day, you never really have early balance. The market just continues directionally, for many cases the entire day. There'd be a lot more about that before we get to the seventh session. But this idea of early on, is the market showing a balance? Is it showing a balance? Or is it showing a trend? Becomes an important consideration when you think of the auction process. So in the above example, see the market balanced through A, B, C, D, E, F, G, H, I period. Then late in the day, the market made a break to the downside. So the market came out of balance late in the day. And so it's called range extension. A buying tail, and remember, if you think in terms of an auction, if an auction is, if the market is auctioning higher, if the auction was completed successfully, it should drop away from the top price relatively quickly. In that case, we would have a selling tail, which we'll talk about in a minute. If the market auctions lower, then if the auction was a pretty good auction, you would expect to see it move away from that auction pretty quickly. In this case of the buying tail, not only did the market break from this, but it left a nice buying tail, and as you can see, price did return back up to the initial balance. So this is a buying tail. Buying tail, another way to look at buying tail is term excess. To have excess, it has to have at least 2 single prints. That's the minimal amount. 1 single print is not excess. So buying tails, here we have a selling tail at the top. You see the market auctioned higher in the second period, and it moved away from there quite quickly, and it left that reference throughout the day. You took an E period, you took 1 tick out of it. Those buying and selling tails are important references as we go throughout the trading session. The point of control, this is extremely important. Early on, when I talked about a change in terminology, early on I used to call this the point of control. And it still is the point of control. It's what's in the books and everything else. But another better way to think about it is the fairest price at which business is being conducted. It is the longest line of TPOs closest to the center of the range, reading from left to right. why do I call it the fairest price? Because it is where price spent the most time throughout that trading session. To auction away and stay away from the point of control is very valuable information. The fatter the point of the control, or the wider it is from left to right, the harder it is to auction significantly away from that point of control and remain away. A lot of times, if you have a prominent or very prominent point of control, or very wide from left to right, an auction below it takes price below value, an auction above it takes price above value, and then there's a high probability that the market will get pulled back to the fairest price of the day. Now, when you first start learning something, there's a tendency to say, aha moment. Boy, I got it. That's why it's never as simple as it looks. And remember, it is an important concept, but one of the things that you will hear me say quite often is what doesn't happen in a market is often more important than what does actually happen. If you go to an amateur or an inexperienced trader and you ask them what the market did today, they will probably give you a pretty good description of what the market did. And it will be, oh, price was up this much, and et cetera, et cetera. You go to a real important, successful trader, and they may spend more time telling you what the market didn't do versus what the market did do. So many times, what didn't happen is more important than what did occur. So the expected thing would be for price to get pulled back to a prominent point of control. Now you're going to ask me, what is prominent? I don't know exactly the prominent, very prominent. You learn this over observations, over a period of time. I just know that having watched this for a number of years, when I get 4, 6, 8, 10, 11 wide, that's very prominent. 5 or 6 would be fairly normal. 7 or 8 would be, fairly wide. I don't have exact numbers to it. It's something you observe over time for the market that you are trading. But the best way to think of the point of control, it's the fairest price at which business is being conducted. And when you think of it in that terms, it makes it much easier to start to think in terms of risk and probability. For example, if the point of control is up where the circle is, and I am selling down at the H period where my cursor is right now, the first thing that ought to go through my mind is I am going short or selling at prices below the fairest price of the day. Now, that may work out. That may work out sometimes, and other times there's reasons to be doing that. But to get started and as a good base, generally speaking, if you think in terms of that, wait a minute, up here is the fairest price, and I'm talking about shorting it right here. Is that a good odds play? The odds suggest that you better be sure you're right, because it could get pulled back to the fairest price. So if you're selling down here, you're selling at prices below the lowest price of the day. When we get done with the example, I am going to go and I'm going to show you the importance of that factor that I just talked about yesterday. Very important, real time. So I'm going to take it out of theory and I'm going to show it to you in real time and the importance of it. Conversely, if you are buying up at the above the price of the fairest price, you are buying at prices above value. Now, the wider this is and the more this is established value, the more risk you have in making that trade. It's, you know, can you quantify the risk? No, but it's a way for you to begin to think in terms of how much risk am I taking? How much reward can I have? And as human beings, we are not very good in thinking in terms of odds and probabilities. Trading is about odds and probabilities. It is not about emotion. It's about odds and probabilities. Okay. The point of control, or fairest price to do business, the non-migration or migration of that point of control is very important. Price sells off in the afternoon, but the point of control doesn't go lower. Traders are getting short, and when traders are selling at prices below the fairest price, we say they are selling below value, or the vernacular is getting short in the hole. What causes this very often is because there is so much emotion. People are just, they're so emotionally trading. They're not thinking about what is going on. They're very shallow, very emotionally bound. Remember, I used a phrase earlier, and that is we are continually bound by provincial impulses. And, you know, it's so easy. We make so many daily decisions based on impulses. We just have to be, if you're going to trade, you have to be able to think in terms of probability and have some idea of the risk reward you are involved in. Again, I'm going to demonstrate the importance of this point of control and how important it is in understanding what was going on in the market when we go from these slides to actually look at what happened yesterday on a very important day. So I'm going to take it out of the theory that we're talking about right here, and we're going to make it very practical in something that was extremely important yesterday and carry through to today. The value area is where approximately 70% of trade took place. In a normal distribution curve, and markets aren't normal, we're not saying they are, it's just starting point. But the value area represents about 70%. It's be 66 point something, rather, but it's about 70% of where trade took place today. It is a great filter when we're talking about these emotions and controlling these emotions. It is a great filter to always be aware of where value is developing throughout a trading session. It is amazing when you hear it here and I talk about it here, it all seems to make sense. When that bell goes off and price starts to move, it is amazing how many people, the market can be underway 4 hours, and I may have somebody that's saying, Tim, I'm really having trouble with these markets. You know, help me, where do I get in, I said, let me stop you for a second. What's value doing today? And they go, they clearly have no idea where value is. Clearly no idea where value is. But, and then they can understand why they're having trouble. They're having trouble because they're chasing price around. Value is a great emotional filter to have a much clearer understanding of what is going on in the market. Understand now that the center of value is what? Here's a question for all of you. Julie, I want to see how many people get this right. What is the center focal point of value? Anybody answering that correctly? See any answers coming in?
Yes, sir. They got it. Thanks, everyone. Yeah, they're on
What
it.
are the answers coming in?
Point of control.
Point of control. The point of control is the center of the value area. Value is decided. You start with the point of control, the fairest price at which business is being conducted, and then you just extrapolate out to the left and to the right. So value is extremely important. But inside that is the migration or non-migration or the formation of the point of control. Extremely important. Okay? Julia came up with this term. Value is your trading GPS, just like any GPS. Sometimes you just have to use direction to find out where you're going. If you look at the profile on your far left, this is where price closed the previous day. The blue area is value, where 70% of the day took place. Just as we're talking about it, notice there is no excess on the low. There was no completion to this auction on this day. It's something that we record. The following day, value is overlapping to lower. So you see value is overlapping to lower. And of course, we did take out that poor low or non-excess low, non-completed profile, and settled down in this area. But the point of control was very prominent. This would be fairly normal point of control. 1, 2, 3, 4, 5, 6, 7, fairly normal. When you get down this wide, very prominent. You can just kind of see the difference in these. Like I say, there's no absolute number. This would be kind of normal. This would be very prominent. This would be prominent, just to give you an idea. So value, if ideally, when you are trading with value, just as a ballpark, what you want to do is, if the value is overlapping to lower, you generally want to be selling rallies and buying breaks, taking profit on breaks in a rotational type of day. That's kind of how we use value. I said, well, what I really want to do is I want to see value. I want to see if I'm going to be short the market or I'm going to sell something, I want to see value decline. If I sell something, I don't want to see value increase. Value is the GPS, the mental GPS when you're trading. Is it perfect? Nothing's perfect, but it is extremely important. Though, again, when we look at the value, the center of value is the point of control. The point of control is the fairest price to do business. The wider the point of control, or fairest price at which business is being conducted, the greater odds it will be revisited either that day or the following day. And you see here, it was revisited on the following day. Following day, value was overlapping, so it was a kind of rotational day. In the final session of the day, value traded, price traded lower in the final session, but it traded down. See how fat this is, and notice price came back up towards the lower end before the market actually settled. It's hard to stay away from a very prominent point of control. Non-excess highs, meaning the auction was incomplete. The current long-term auction occurred following the State of the Union address on a Wednesday. There is no excess on the high. There is no excess on the high. It is an incomplete auction. That is only a single data point. It's only a single data point, but it's something to notice. Auctions the general way auctions exit or end is with significant excess. If there is no excess on the high, sometimes what you'll have is a gap, a lower gap the following day. Sometimes, and particularly S&P, I've seen them in the last several years, I've seen 2 or 3 times when a long-term auction has ended just because the market's got too long. So it's something that we are aware of. I carry it forward all the time, but it doesn't bring me to a standstill in business. Excess low, completed auction, at least in the day time frame. So you see this market, this was a day that gapped higher and the market moved up quickly from the opening. So there was excess down here. There's nothing to show that there's anything on the downside. This market just opened there, moved up quickly. Price was moving very rapidly through time. Excess low, the 2 most important concepts we will ever deal with are excess and balance. Excess marks the end of an auction, the beginning of another auction. Balance tells you that the markets are in a fairly decent trading range. It's the breakout of that balance that provides great opportunities. We're going to talk a lot more about that before we get to the 7th session. But excess and balance, 2 most important concepts that we deal with. Okay. Again, on a very wide range day, often a trend day, late in the day you will get a rally, or late in the day you will get a break. So if this auction market is auctioning down, late in the day we get a rally up to the K period high. Then the market breaks substantially throughout the remainder of the day. This rally high becomes a significant short-term reference for traders. Now we're talking about something that you don't hear. The only people you hear talk about things like this are generally people that have been involved in one of our educational programs. Trading is about change. The market changed here in the afternoon very quickly and sold off. If we trade back above that the following day, change has been ushered in once again. Failure to go back above this keeps this high in place, and it keeps our pressure to the downside. So it's a reference that we carry forward. We're always looking for indications that there has been some change take place in the marketplace. On the opposite end, if the market is rallying in a trend day up, as this was, and you get a late afternoon pullback, that late afternoon pullback becomes a significant reference. Again, if the following day you stay above this pullback low and the daily high, then you have no real meaningful change relative to the previous session. If, in fact, you trade below this on the following day, then there is an indication that change has taken place. Trading is about change. The example that Julia has used here, we did easily trade below this the following day, and trading below that has led to, I think it was 6 or 7 days of the market one time framing lower. So that, again, is a reference that I will tell you most traders, no matter how long they've been trading, have no idea what I'm talking about. They've never heard of it. It's something I've observed over time, and it has become a very meaningful part of being able to look at the market. See, remember, we use the market profile to organize the data. That replaces having listened to the data as a floor trader. Now we look at we use our eyes to look at the market, to have some understanding, and as traders, we're always looking for indications of change. In this case, following this trend day, the market easily traded below this the following day. It did signify change, and I think for the next 6 or 7 days, the market one time frame lower. So these can be, and it's amazing how many people I will ask, I'll have a day like this, and I'll say, okay, you're having trouble trading. What was the pullback low yesterday afternoon? They saw, I don't really know. Well, you know, it's there, and those are the things you need to know. You always have to be thinking in terms of odds. You have to be thinking in terms of, is there a change in the market or isn't there a change in the market? Very important considerations. Okay, now, what I'm going to do next is I'm going to go to yesterday's profile. I'm going to show you in real time something that happened yesterday that was extremely important to understand what the market was doing. Yesterday was one of the most important educational sessions you will ever come across. We are going to put out a highlight reel this weekend, be our weekend highlight reel, that lists all of the salient pieces of information from yesterday. It'll allow you to study it. It will allow you to see the day play out. I think it's about 9 to 10 minutes. But it is an example of where you want to be when you finish the second Masteries course. It's close to the term we hear, trading in the zone, as you can imagine. And it's a very significant thing. It happened yesterday. We were in the morning, we were talking, we had a webinar, we were talking about this in the morning, and it's going to be fully explained this weekend. But before I do that, I want to do two things. One, I want to cover some very quickly some things that labels that have changed from when we first wrote Mind Over Markets. And then I want to see questions based just on what we have discussed so far. Then I want to go to yesterday. So things that we used to talk about in the book, we talked about day types. We identified day types as in 5 different types. We no longer label the days that way. Basically, it still would be semi-relevant, but basically what we want you just to think of, instead of with labels, labels are too exacting. And we want you to be able to think in terms of, what does the day look like? Does there look like there's a natural balance or trading range to the day? Or does the day look like it's just proceeding directionally? Each market needs to find a place where two-sided trade can occur. Think in terms of any business. You don't have a good business unless two-sided trade is occurring. You may think you have the greatest idea alive, but if there's no two-sided trade, your business isn't good. You're not going to make any money off of it. So you'll see, even like a day like yesterday, the two-sided trade, it explored to the upside, it explored later in the afternoon, explored to the downside. Two-sided trade was taking place in here. So you're always looking to see where two-sided trade take place. Then you're looking for deviations from that. So I'd rather have you think in terms of that rate, rather than think in terms of absolute day time frame types. We love to have labels. Labels make us feel secure. I'm concerned that those labels, in many cases, turn out to be give us a false sense of security. We still label things like excess highs, excess lows, poor highs, poor lows, which we'll talk more about. So we do some label. Point of control is clearly a label of the fairest price at which business is being conducted. But we want to get it down to a minimum. We want you to just be able to begin to visualize what the day will look like. So the day types have gone away. We don't label those day types anymore. We used to have something called point of control, or TPO count. We would count the TPOs above and below the point of control. We don't do that anymore. That was something that was basically used to get an idea if the local floor traders were too long or too short. We don't do that, but we still do it in a different manner, and you're going to see it as I go to the real example of yesterday and see the importance of the point of control. It's not TPO count, but it does significantly use the point of control at fairest price at which business is being conducted in order to have a realistic idea of what is transpiring in the marketplace. Julia, can you think of any other terms that we don't use anymore that we should discuss here before we move on? Julia, you there? Hello? I don't know if you can all hear me or not. Are we not live? Julia?
I can hear you.
Oh, Jen, you can hear me. Okay, so we're still live then, right?
Yes.
Okay. Julia's gotten distracted, or she's working on something. So
I'm here.
When we come back, if she's got any terms that I haven't discussed, we'll go to those. Okay, what I want to do now, Julia, are you there yet? Well, we can't take questions if Julia's not there. Hold on, let me text her. I just sent her a text to see if she's there. I don't know why she's not with us. Jen, can you see the questions by chance?
Yes. Give me a moment and I'll look through them.
I'm here. I'm sorry.
Oh, there's Julia.
I was on the phone, someone having a problem getting in, but my mic wouldn't turn on. I had muted it. Sorry about that,
Okay.
everyone. You want to take questions?
Where we are, we're seeing if,
I'm
before
watching.
I go to
I'm
yesterday
right
to make this more real, are there terms I've covered about, we don't do daytime frame types anymore, and we don't do TPO count. I've done those. Are there any other terms that you can think of that we should inform people that we don't use anymore, any more labels?
The initial balance, you didn't, the first hour, you already explained that. And also that 80% rule, where I used to use it too until I had gone to one of your seminars, that the initial balance can say project where the range for the day is going to be. You don't do that anymore either.
We don't do any of that. And the 80% rule that Julia was referring to used to be that if you re-entered the value area from either above or below, there was an 80% probability that you would trade to the opposite extreme. What happened, I got that from the person that initially came up with the idea of the market profile, and I took it verbatim, but as I studied it over the years, I determined that it really wasn't that reliable, and there are people that still use it, but you're much better off, instead of using a mechanical reference like that, you're much better off just to be able to see how the auctions are developing. Any other terms?
Well, you went over it in terms of the rote learning and said you don't use day types anymore. It's more important to understand what's going on. So there's not the neutral day. I think we do call a relatively normal shape distribution a primary day. We use that in the field of vision. but you're not
Yes.
using all those day types. That's just rote learning. And also, yesterday in the webinar, a gentleman who, isn't a client but was watching the free webinar, he said, why isn't Jim calling the open an opening test drive? Because we had opened at the edge of range and gone lower. And I didn't have the opportunity to ask you that question, but, I typed back that it's not just, oh, well, it ticked one tick higher. Actually, it didn't even. It was technically an opening drive. But the confidence, the tempo, the velocity of price movement on the open as it ticked lower, it may look like an opening drive or an opening test drive. I think he came in late because eventually A period came up and went one tick higher than the opening. So you can look at it in hindsight and go, oh, there's an opening test drive. But actually, you'll learn this as you continue to listen, that it's not just looking at it and saying, oh, blip, lick 'em, stick 'em, there's your label, that's what happened. Jim will often say, yes, but how did it happen? So it wasn't an opening drive yesterday because, yes, it did open and go lower, but it wasn't like this, everybody selling it and it's moving and the tempo and the confidence. It was like moving in peanut butter. It wasn't an opening drive. So
It's just,
again,
and
the
of course,
rote labels can get in your way of just
absolutely.
connecting with the market and what's going on because we're so eager. And I fall prey to it too in my life. We're so eager to put a label to something. Like Jim said, we love labels. It's like making a list for the day and ticking items off the list. I mean, it's like, oh, and then you realize, gosh, there's about 3 things that make 80% of the difference and I haven't touched those yet. So I don't know if it's Pareto's rule or something. So anyway.
And the other thing is, the same opening that takes place within the middle of the previous day's range is totally different if it takes place outside of that range. Context is everything. And what we really want you to, what we want to do, we go through this, is teach you how to think. And I understand it's really nice to have some rules and labels to begin with, but they can impede your growth. And what we're trying to do with this is, we've talked a lot about how we teach, and the way we teach is pretty much immersion learning. And when you teach things linear, we could start off and do very linear type of teaching, but it is very difficult then to go back and integrate that with all the different contextual changes that are so important. And remember, again, you're competing. There are no practice fields. You are competing against the world's best traders as well as the world's worst traders from day one. What you hope is that you don't fall in the category of one of the world's worst traders. Okay, now before I go into tomorrow, or I'm sorry, into yesterday, and show you some real-life examples of how some of this works, let me take any questions based upon what we have just talked about. Please.
Okay, sure. Thank you. Okay, would you please explain on the slide showing the overlapping value areas, how come after that prominent POC, which made a 45-degree line, the next day the market broke downward instead of going higher? And for anyone that wants to look at this, this is the day that we, oh, I beg your pardon, it's not the video clip day. Don't mind me.
I will come back to that question. I will come back to that question when we go to yesterday.
Okay,
and
one more about the, go ahead. There's a question about the rally guys. So
we get biases in our mind. And yes, we may say, well, there's, Jim always teaches, there's a good chance that we will come back to a very prominent point of control. And so you get it in your mind that you're going to, if the market goes below that, you're going to buy it to come back to that. The odds are good. However, they're not 100%. And there's always things that happen. In some cases, the market has to take care of current business first. yesterday's current business was that crude oil was off over $1 early on. And the market was, there was no serious money in the market, so short-term traders were automatically trading off of crude oil. There's a lot of emotion that goes on in the market, and that's what we have to live through. You have to have the mental flexibility. If you yesterday morning, when we get to yesterday morning, we're going to address that question you're talking about again, but yesterday morning, I came into the market with that bias of looking for a place to buy for return back to the very prominent point of control, as well as a poor high. It didn't happen. Okay, most of the times it does. It didn't happen. As a trader, you have to adjust to that kind of information. Now, when we go to yesterday, I'm going to show you how I still use that information you referred to, and we'll do that in a couple of minutes. Okay, another couple of questions, please.
Yes. Can you give more details about exactly how you would use the rally high from the previous day in the next session?
Okay, I only use it if it was a significantly wide range for that day, and as the example in front of you, and the rally high in the afternoon was pretty obvious. Okay? So the first thing I'm doing, I know that if I get above this, I have change. And if I don't get above this, I don't have change. In other words, if I stay down in yesterday's range, there's no change relative to yesterday. Now, the question is, well, how do you use that? It's a great question. And the frustration is that I don't have an absolute answer for you. The first thing I look at, if I stay below that change, I know that the market was soft yesterday, and if I stay below that and I'm trading in this range, well, there's no real change from yesterday afternoon. I'm still in a rotational environment, so I will look to trade the rotation. If the rotation looks higher, I'll look to fade it. If it rotates lower, I may look to buy it. I will say, okay, I'm still in a rotational environment. It doesn't give me an exact place to enter or an exact place to exit. It gives me a broader understanding that there's no change relative to the previous day, or no change to the upside. So this market rallied, that was the high, and then it broke. Well, as you can see from, we didn't come back to that, that day. So again, that's how I'm using it. It doesn't give you any help where to buy, where to sell. It gives you a general overall view. So if this high was made, the market starts trading, it's okay, the short-term trend is now to the downside, there's been no change to that. Or if it stays in below that, rotation will say, okay, we're still in a rotational environment, there's no change relative to yesterday afternoon, we're still in a rotational environment. Another question, please.
Yep. And if I can just add very simply, rally highs and pullback lows are so powerful for just becoming and being anchored in the next session, because it's a fulcrum for change. So right away, and we saw this in a webinar last week, in the week prior, Jim used it in the first webinar we had coming back, and then the next week he reviewed, we were at the end of the session, what's going on for tomorrow, Jim? What's going on? And Jim addressed it. Okay, we have a pullback low here on this trend. Tomorrow, if we escape that and we start to trade lower, in other words, something has changed from the trend in the afternoon yesterday, our destination is the gap. It was the day after, I believe, the big gap up. We had our first webinar March 1st. That was also a 14-point gap up in the S&P. So it's just a really great way. You want to get situated and anchored in the session and have some levels that let you, really just see the big picture. Because I don't know about you, I can get turned around in a session like scuba diving. You're in the water, you don't know where you are because it's up, down, you forgot what your plan was. And anyway, with that level marked clearly on your chart, you are right on it. You're like, okay, something's changed from yesterday because we're not going higher. We're below that pullback low. So, there's a lot of ways that we'll get more sophisticated in how we apply it, but just that in itself, you can walk away today and use that tomorrow if there were that situation in the market and start applying it immediately. So I just wanted to say that.
See, a lot of people, when they hear these things, and particularly when you're really starting, their questions always revolve about where do I get in, where do I get out, where do I put my stop? That line of thinking has to go away. What happens is, and when the trade is, if you are looking for a trade, you're going to be probably very disappointed. You have to get to the level where the trade comes to you. Now that is easily said. It is very difficult to do, but that's the level you want to get to. You want to be able to think about a market, and you're not looking for a trade. The trade just comes to you, and when the trade comes to you, you recognize it. It's like playing basketball. All of a sudden, somebody's open, you recognize it, and you pass under the basket. That concept, I mean, it's great we're talking about this in the first beginning session here, but that's really where you need to get to, and it really is hard to understand. It's hard to explain. It appears very ambiguous, and it's so inconsistent with what so many people have heard and read over the years. I mean, I see these ads for these companies, where to get in, and where I think TD Ameritrade, where to get in and where to get out. And it just simply, for short-term trading, doesn't work that way. You have to be able to be in the flow of the market, and then you will recognize the opportunities when they come to you. Okay, let me take two more questions, and then I'll go to yesterday and kind of put a couple of very key points together.
How am I ever going to know the market is trading off of crude oil?
That is a great question, and it's, again, through observation. And normally when it starts to trade off of something like crude or trade off of the dollar index or something, it occurs when they're at extremes. Okay, so for example, crude wasn't having any real effect that I could see on the market until it broke under $50. Just kind of a magical $50. And then all of a sudden, that started to get the attention of the short-term traders. And then they start to remember that last time we had crude go down and we had an overall slump in commodities, it took the market way down about 4.999%. And they remember that, and they do, they say, oh boy, that's going to be the trade. And then the next stop was when yesterday morning the market broke under $48. Again, there's no whistle that goes off. It is just being aware of what is going on in the marketplace. You'll see it sometimes, the dollar index. As long as it's well behaved, it's not having any real impact. And then all of a sudden it'll spike up or spike down. All of a sudden, now let's say it spikes up. Oh, traders start selling off stocks because they say that's going to make our large companies more competitive because of the dollar. And then you'll have a couple of days where you get these short-term moves, based on the dollar index. That's part of trading. It's not the fun part, and some people get very upset by this because they want to have it be more scientific. They want to have it be more exacting, and they want it to be easier. And it's just not. There is a lot of things that go on in the market, and what you have to do, what we're trying to teach here for short-term trading, you have to learn to read the structure of the market. and see what's going on. And it's not easy, but remember, the stakes are huge. The winners can make a lot of money. There's a lot more losers than there are winners. The stakes are huge, but that is not going to come without risk. And in order to compete, you have to have somebody showing you what to look at. You have to know what to look at, and then you have to develop the mental flexibility to be able to relax and just go with the market. Okay, another question.
Yes, and one thing to keep in mind, because I know it gets people we have many traders who are constantly looking at the NASDAQ and the Dow and making these interrelationships and bringing it into their S&P analysis for trades. And Jim will say, analyze and trade the market you're trading. To be looking at the NASDAQ trying to make E-mini S&P trade decisions is very counterproductive. However, that said, to keep it simple for you, the person who asked the question, it's usually when there's an extreme in the market. Years ago when we were doing seminars in the live market seminar, I think in Chicago, everybody was following the dollar. So we had to pay attention to the dollar because the dollar was at extremes, and it gets everybody's attention. Then you get the talking heads saying that U.S. exports are too much money, they're valued higher, and the S&P starts, for a while they were inversely trading dollar higher, S&P lower. And Jim had said it's kind of funny because normally, historically, a stronger dollar means a stronger economy. But guess what? It doesn't matter. We're not economists. We're traders. And if that's what they're doing, that's what we're going to be following. So you don't have to get caught up and feel like, God, does this information ever end? It's more, like crude's off a buck. And just have it up on your chart or a ticker board so you can just see where it's trading. And I know Jim, we've traded together, and he has CNBC on and has it on mute. So you can always just kind of stay plugged in. We know many traders that are in here right now, or a few, that they pay $300 a month for news so that they're aware through their headset of what is going on, every second of the minute of the hour. But don't get too bogged down with that. It's only when things are at extremes and everybody's talking about it. If you have the news on, you're going to hear about it. It's not some secretive thing that you're on the outside of. It's pretty mundane, known to everyone information.
I also trade through TOS, and sometimes I will have they have the program on. So sometimes I can listen very lowly. Pardon?
CNBC, you mean? In
yeah,
Thinkorswim platform.
Got that on. Mm-hmm. All right. We're running against the limit. Let's go to yesterday, and let's just put some of the things that we were talking about this morning to work. I'm going to take out the overnight to make it a little simpler. Okay. Remember that I said earlier, you're going to get a weekend highlight reel this weekend. It is going to meticulously take you through yesterday's trading. You're going to have a terrible time understanding all of it, but it is an example of what a professional trader operating in the zone will see and feel. But for right now, I'm not going to do the whole day. Right now, I am going to show you a couple of things that are very important. We're going to spread out yesterday. And when the market opened yesterday morning, we had a very prominent point of control. We had a poor high that had not been taken out, a very poor high that had not been taken out. I had a bias that I was looking for an opportunity to buy. It didn't present that opportunity to me. Instead, the market began to sell off early in the morning. You're going to see the actual sell-off and more details of that when you look at the highlighted reel this weekend. But what I want you to see is we spent a lot of time talking about value, and talking about the center of value is the point of control, and we've talked about the migration of the point of control. Yesterday's attempted direction was down. The market opened, tried to go lower. It traded lower for 1, 2, 3 periods. The gold numbers or letters that you see here represent the early point of control. Then the point of control moved up a little bit, and then when the day ended, the point of control moved all the way up here. Remember, the point of control is the fairest price at which business is being conducted. The longest line, meaning reading from left to right, from the center of the range. With the market attempting to trade lower all day yesterday, the fairest price rose 3 times throughout the day. Now, short-term traders, this is what I really want you to kind of grasp. Short-term traders, with all their emotion, came in and boy, it was an easy one. They're just going to sell based on crude oil. And they do that, and they get trapped. The market rallies. What do the short-term traders do? They sell it again. It rallies. They sell it again. So short-term traders all day long yesterday were selling every rally. We didn't take the high out. But yet, stronger, smarter money was underneath that market buying those breaks. And that's why the fairest price at which business was being conducted rose from here to here to here by the end of the day. Very significant information. If you got the report I wrote last night, I expected a continual rally either last night or today. What has happened? The market has rallied today. Okay? Next, we talked earlier about the 45-degree line. If this is at 23.65 even, is the fairest price at which business is being conducted. Short-term traders that were selling every rally were getting short in the hole, and they were still getting short in the hole. See how they tried to sell the L period off. Short-term traders were continuing all day long to sell the market. Yet underneath the market, by organizing the data like this and looking at the fairest price at which business can be done, I am seeing that the fairest price throughout yesterday's entire sell-off is rising. And I'm sitting there saying, this is the 45-degree line from here to the high. This is the fairest price at which business is being conducted by the time we get to the end of the day. Yet traders are selling price below value, getting caught short in the hole. That's why you rallied. You rallied coming into the close. You didn't take the high because they were still aggressively selling those rallies. That's what they were taught to do. I'm going to go back over. I'm going to put the overnight back in. So you see we opened overnight, basically traded unchanged, and then most of the night was up, and we're up today. You see the results of what happened. So all that information we were collecting yesterday. And yeah, it was against here. Somebody said, well, why didn't we go back to the point of control here? You carry that forward. Yeah, very prominent point of control. The odds are high that we return to that. Poor high, odds are high, we take that out. Well, it didn't, but that all affected the odds going forward. Is that hard to keep track of? Yes, it is. I don't doubt that at all. As I wrote the piece, as you see this weekend, one of the things I wrote is, I'm going to split this out again. We talked about emotions in the market. What do you think my emotions feel like? I'm doing the webinar yesterday. I see the market going straight down. And, you know, you people have spent a lot of your time and effort and a lot of money. And the logical question is, you know, well, wait a minute, if this guy's so good, why isn't he selling? Well, you know, why isn't he shorting the market in here? Okay, I wouldn't have shorted this market for anything, even if I was wrong. I didn't think the odds were in my favor. I didn't think they were in my favor because of this poor high. I didn't think they were in my favor because of the prominent point of control. And yesterday morning, the market opened. It opened right, there was the high price following the opening. Market traded off in a period down to the overnight low, rallied one tick above the early high, exactly at the previous day's low, and then sold off again. I saw this as what we call a weak high, weak because it went to an exact mechanical reference. So there's no way, when just from my way of thinking, I'm one person, but my way of thinking, the odds of being short this market were not in my favor. But you say, well, yeah, but Jim, you know, we got a high up here of 23.69. The market went all the way down to 23.58. That's you know, that's 11 handles. You let 11 handles go by. You know, I thought you were a trader. Okay, I am going to trade my market. I'm going to look at the odds as I see them. And part of the thing as a trader is only to trade when you are comfortable trading. Did I feel the emotion of not being short when the market's going down? Yeah, because you know, I'm sensitive, I'm human. People are saying, oh, this guy, we're paying this guy, and he's not short. What's wrong with him? Well, it wasn't my trade. But this market came to me. And then I'm watching, and here's the weekly low from the previous week, right down to 23.53.50. And the market didn't take out that low. It finally left me a excess low. And I traded the market from the long side 3 times yesterday. Turned out to be a very good day, as well as I went home long last night. So the trade came to me based on the odds, based on watching the flow of the market. The trade came to me, but I understood enough of what traders were doing, so as the market rallied up here, I would take profits. Now, some of you may see a total conflict from what I said earlier. I said generally, if value is lower, you generally want to be, you know, selling rallies and taking it back on, selling breaks and taking it back on rallies. And I was doing just the opposite. I was buying breaks and selling on rallies yesterday, taking profits on rallies. Well, everything is a series of facts surrounded by other circumstances. And what I saw, based on the odds of the incomplete auction up here, the prominent point of control, the very poor high yesterday, and then the rising point of control throughout the session, said to me, traders were getting short in the hole. Now, that is an awful lot of things to talk about and expect you to comprehend when we say this is day one of a 7 webinars, starting with the very basics. Yes, did we start with the basics? Yes, but I took something as basic as the prominent point of control and the migration of that point of control, and I just took it and put it in real life. Is that complicated? Absolutely, it's complicated. But remember, it's on the reel this weekend. You go over several times. But I wanted to give you something of real that happened yesterday. I wanted you to see the effect of the 45% rule, 45-degree rule. It just tells you that's the point of control. People are getting short in the hole. Most traders yesterday didn't understand what was going on. Most traders yesterday probably got cut up pretty badly. They probably got whipsawed throughout the session. Anyhow, that's a lot to talk about on the very first session. And I'm sorry to end up so complicated, but this is really what you're working for, and this is what it is really all about. Anyhow, we've been an hour and a half. Let me say thank you very much. And I'm sure there's a lot more questions that haven't been answered. We have email, and I'll attempt to answer your questions. But I hope this first session gave you some start of a foundation in which to begin to join us through this educational experience. Let me say thank you very much. Julia, let me say thank you very much.
Okay, great, Jim. Fabulous. Really well put together. Thank you for this. We will have this recording up at the training site where you saw the registration link about an hour or so. You have the slides there as well if you want to download them for your archive. And really, thank you very much, everyone, for being here. It's great to see you all. We'll be back next week with another private webinar and the highlight reel coming out this weekend, another public webinar next week. So stay in touch with us. The next report will be on Sunday for Monday's trade. We'll follow up Tuesday for Wednesday's trade next week. So a lot going on. And we're so glad you're with us for this odyssey. It'll be a lot of fun, though. So thank you, everyone. And thank you very much, Jim. That was so well done. So we'll be in touch. Okay. Have a great afternoon or evening wherever you are. And until next time, thank you, everyone. Bye-bye.